Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Lumen stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Lumen is a telecommunications company. It is one of the largest providers to global enterprise customers. So they're less focused on the retail customer and more focused on the businesses. They offer local and long-distance voice, broadband, Ethernet, video, and network. It has clients in more than 60 countries. The company is headquartered in Monroe, Louisiana, and was founded in 1930. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 11 billion market cap. They're trading at $10.59 a share, and they have 1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see they generate lots of free cash flow. That's why they pay such a nice dividend. It was $3 billion in 2019, $3.6 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. They did have a big negative in 2019 and 2020 due to large impairments, but it is positive in 2021 and the trailing 12 months. Revenue is a sales for the company, and that's been declining over the years. It was $22 billion, it's down to $19 billion. That's where the stock price seems so undervalued, because the revenue is going down and less people are buying the stock. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And that's been declining from 12 billion down to 11 billion. Even though their revenue is declining, their margins are actually getting better. Their gross profit margin went from 55% up to 57%. So they're becoming more efficient. Gross margin is gross profit over revenue. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. And their operating income actually grows from 3.8 billion to 4.4 billion. So as you would expect, their operating margins improved a lot from 17% to 23%. So it is possible to become more profitable as your revenue goes down if your margins go up at a faster rate. They paid 1.5 billion of interest on their debt, which is down from 2 billion in 2019. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. And that's why they had negative net income in 2019 and 2020 due to these large asset impairments. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which was 2.2 billion, a lot higher than 2019, 2020, and a little higher than 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. They spend a lot on CapEx, 2.8 billion in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And a bulk of their free cash flow goes back to you in the form of a dividend. They also been paying down a lot of debt. They paid down 3.6 billion in 2021, added 1.9 billion. So they decreased their debt load 1.6 billion in 2021. They decreased it 3 billion in 2020 and 700 million in 2019. Let's look at the capital structure. They have 12 billion of equity, 29 billion of debt. They're 30% equity, 70% debt. So they are pretty leveraged. And I use the middle whack on Finbox, 8.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 17 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $20 billion. We divide that by 1 billion shares. And we get a calculated stock price of $20. They're trading at $10.59, so they're trading at a 46% discount. It's a buy according to the model. Their revenue target for 2024 is 14.9 billion. For 2023, it's 15 billion, and for 2022, it's 18 billion. And I continued this trend into 2025 and I got 14.8 billion. That's how I got their future revenue estimates. They convert on average 16% of their revenue into free cash flow, so I multiplied their future revenue estimates by 16%. That's how I got their future free cash flows. The website Simply Wall Street is right with me. Their valuation is $22. They're saying the stock is 51.1% undervalued. 4 analysts priced this stock and the average price target is $10.38. The low is $9.50, the high is $12. This is where the stock has been trading the last 5 years. So in July 2017, it was $25. And you can see the stock price has gone down more than 50% since that point. That's why they pay such a high yield, because their stock price came down, but they're not cutting their dividend. So they're still paying the same dividend with a lower stock price, which gives them a high yield. You can see they've been paying a 25-cent dividend for several years now. That gives them a yield of 9.5%, which they can easily afford. It's only 29% of their free cash flow, 48% of their net income. You can see the past 10 years they paid a really nice dividend. At one point it got up to 13%, and the forecast is for the yield to be 9.4% by 2024. The last time they did a stock split was 23 years ago, a 3-for-2. And they also did a 3-for-2 in 98, 93, 89, and 88. They have a beta of 1, so the stock moves with the market. It's gone down 28% in the past 52 weeks, while the S&P is down 12%. The 52-week low is 9, the high is 15. And the stock is on a decline, trading below its 50-day and 200-day moving average. 12 million shares are traded each day on this stock. Of the 1 billion shares outstanding, 950 million are on float, 79% are held by institutions, and it has a pretty high short percentage. Over 14% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd only have $6,100 today. That's a 39% loss, a 5% annual loss. The CEO of the company gets paid $1.8 million a year, and their total compensation package is $23 million. In the past 12 months, there's been one insider buy at $12, 5,000 shares, but there's a lot more selling, 25 million shares at $12.51, and 2 other sells. 71% of the company is held by institutions, 21% by the general public, 7% by VC and private equity firms, 1% by individual insiders, and a small percentage by the state. Similar to their revenue, their employee count has been going down over the years. They're currently at 35,000 workers. Here's a list of their top 10 biggest shareholders. Vanguard at 11%, then BlackRock, Temasek, Southeastern, State Street, First Trust, Dimensional, Geode, ACR, and Morgan Stanley. Let's look at their financial ratios. Since their stock price has come down so much, they have a really good PE of 5.1. That's stock price over earnings per share. This means investors are paying $5 for $1 of earnings. A price to sales of 0.6, a price to book of 0.9, and a really good price to free cash flow of 3.0. That's stock price over free cash flow per share. Their return on invested capital is 9%. They can cover their interest payments 3 times with their operating income. They have a high ROE of 18%. A good current ratio of 2.1. That's current assets over current liabilities. Same thing with the quick ratio, 2.1. They generated $3.6 billion of free cash flow in the trailing 12 months. They have over $6 billion of working capital, and they paid out $1 billion of dividend payments. So the company is really well capitalized. The best way to look at ratios to compare them to companies in the same industry. There are 64 companies in the same industry as Lumen, and if Lumen has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend a little more than average in CapEx. They are more leveraged than the average company. For every dollar of equity, they have $2.40 of debt. They pay a really high dividend, a lot higher than average. They generate more free cash flow than average. They rank 18th in market cap at $11 billion. The average is $18 billion. And their price multiples are amazing, much better than average. They generate more revenue than average. Their 5-year annual revenue growth rate is below average. I pulled this number from a website. I would expect it to be negative, unless they had really low revenue 5 years ago. But at least in the past 3-4 years, their revenue has declined. Their ROA is 4%. That's net income over assets. It's how well you use your assets to generate a profit. ROE of 18%, that's net income over equity. It's how well you use your equity to generate a profit. So to summarize, I have them trading at a 46% discount, but I don't see this stock increasing that much. Since their revenue is declining, people aren't willing to pay much for this stock. That's why it has such a high yield. Probably 95% of the people in this stock are in it for the dividend yield. And there's nothing wrong with that. And if they could turn things around and start to grow their revenue, you could make a huge return on this investment. I rank their free cash flows 8 out of 10, their revenue 7 out of 10, and their ratio is 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.